If I bought my first rental property, these are things that I would consider. And it's not that you should consider them, you have to consider them, or else you will pay more money to your tax accountant because you're messy and you're gonna miss out on deductions. And two, you're going to likely pay more in taxes because you didn't follow this and keep track of all of your expenses. So let's dive in and I'll tell you step by step what you need to keep in mind when you're buying your first rental property or your 10th. My name's Matt. I'm a CPA that specializes in real estate taxation. I'm also a real estate investor myself, full-time dad, running a family with my wife, but I like to get online and talk about taxes, and I run a tax and accounting firm called TrueBooks where we help clients that are in this same situation. So I've seen this play out a zillion times, and I watch people overpay in taxes and overpay in fees. If you came to our firm messy with none of this in order, we are going to charge you more. The guy around the corner is going to charge you more because it's more work for the tax accountant to do. So that's why we're here to talk about it, so I can queue you up for what you need going into tax season. So let's talk about a quick example of buying a rental property. I have an easy example here for maybe a property that you would buy in the Midwest. Let's assume a $200,000 purchase price. You put down 25%, so that's 50 grand, and you're gonna take out a mortgage for the remaining 150,000 bucks. So 200,000, you put down 50, you finance the other 150. Your payment on that every single month is going to be about $805, with the allocation between principal and interest on that payment, about $625 of interest, $180 of principal. Now those numbers will play a bigger role when we get to the back half of the video and talk about deductions, so stick with me. The first thing that I want to talk about when it comes to buying a rental property is, should you put a rental property in an LLC? This could be a video of its own, but I want you to remember a couple things here. If you put a rental property in an LLC, there are pros and there are cons. Some of the pros are, it is going to give you an extra layer of liability protection. Now you are removing this asset from your personal holdings and it is now going into a separate entity, so that ideally if something goes wrong, it'll just be within that LLC and they can't ideally come after you or anything personally for something that happened with that property, such as a slip and fall from a tenant or something dramatic happening that you could be sued for. I would say that's probably the biggest pro when it comes to setting up an LLC for your rental properties. A couple cons are, it's going to cost you more money. If you're in the state of Nevada, that's 425 bucks that you have to pay to set up that LLC in the first year that you set it up, and then another 300 bucks to renew that LLC every year. So there's increased cost there with going with an LLC. Not to mention there's also more admin work. This is an LLC now that you have to manage and take care of, and you have to renew the entity every single year and keep documents for it. So there's more admin on that side of it as well when you have an LLC for that rental property. The next million-dollar question is, should I have an LLC per property? I'm not an attorney, so this is not legal advice. Heck, this isn't even CPA and financial advice. This is informational purposes only. But rule of thumb, what I've seen in practice is, you do not need an LLC per property. If each property is very large and these are bigger deals, maybe an LLC per property makes sense. But what I like to look at is my risk tolerance. For example, if I have 10 properties, 8 are in a good area, 2 are in a bad area, maybe I put the 8 that are in an okay area in one LLC and I separate off those other problem properties, the other 2 in a separate LLC, so that if anything happens, I'm ideally segregating anything happening to the good properties if something were to go awry in one of my poorer location properties. So rule of thumb, likely don't need an LLC per property, but it's always an option if you feel that you need that and your attorney and your CPA advise you to do so. Next, we're getting into bank accounts. So LLCs, that was a if you want to do that. You don't need to do that, but I want you to have a little bit of general information if you want to go that route. This is something on this next step that you will have to do, and this is banking. And we have 2 routes that we're gonna go here. Obviously, if you go the LLC route and you choose to set up an LLC, you need to have a bank account under that LLC's name. Keep in mind, for you to get a bank account for that LLC, you're also going to need to get an EIN, an employer identification number. This is, think of it as a social security number for that LLC. So if you get an LLC, when you get to this banking step of your process, you need to get a bank account under that LLC. This is the bank account that you're going to collect all your rents from. You're going to pay for all the property expenses from. You're not going to wire money to buy the property from this LLC bank account because you likely didn't even have that open yet. But anything after the fact, once you buy this property, all income and expenses should flow in and out of that LLC. Now, let's say you don't set up an LLC. I need you to get a separate personal bank account to keep track of all of the activity for this property. This is where most investors go wrong. Then come tax time, they're scrambling to find out what happened. They're looking through their personal bank statements, their credit card statements, and they have activity all over the place. This is the point of having a separate checking account to keep track of all of your income and the rents that you get paid every month and all of your expenses that you have to spend on that property as well. It is going to save you so much time come tax season, or save your accountant time if you pay your accountant to compile this information, because now it's all in one spot. You're not running around to 18 different locations looking for the activity that happened last year. So my recommendation is, if you have an LLC, get a business bank account for that LLC. If you don't have an LLC, totally fine. You need to go get a separate personal bank account to keep track of all of your income and expenses here. Very important piece that a lot of people miss. So we have our LLC, or not, that's fine. Now we have our banking set up. All transactions are going in and out of that. We need to have a process to track this activity. Yes, it's good that we have all of it flowing in and out of one bank account, but we don't know at a high level categorically what's happening. What do I mean? I'm 6 months in from owning this rental property. What's the total rents that I've received? What's my total expenses? What have I paid in total utilities? What have I paid in total mortgage interest? I need a way to track this now. And this is what I would do if you're a newbie. I would use a spreadsheet. If you want to take a leap and use something like QuickBooks, which is an accounting software, totally fine. I'm not sponsored by QuickBooks. I am a QuickBooks fanboy. I use QuickBooks in my personal life, in my portfolio. At my firm, we use QuickBooks to manage our books and all of our clients' books. So if you ask me, a little biased, but I would recommend using an accounting software that'll keep track of all this information for you and make it a little bit easier. If you're newer to investing and maybe owning rental properties, starting off with a spreadsheet is cheaper, and it's a totally fine way to do it. It's just going to take you a little bit more time. Let me show you what this template looks like and how you would use it for your own rental property. Okay, you're looking at a rental property, as you can see in the top left, rental profit and loss template by TrueBooks. That's the firm that I run. So I'll link this template in the description as well. Feel free to use it, take it. There's even a link on there on how to use it, but I'll walk through this really quickly. Here is an example of one in this column B right here, this yellow highlight, showing you the information that your accountant is going to need come tax time, which is what's important here. We need to keep your books and records organized. So what? We don't overpay in fees and we don't overpay in taxes. Notice that there's a couple pieces of general information up here that we need. Full address. We need type of rental. Is it a long-term rental, short-term rental, Airbnb, something like that? We need to know the ownership percentage. Do you own 100% of this? Do you own 50% of it? Something like that. What is the date that you placed this property into service, that it was available for rent? We need to know that. How many days was it available for rent of the year? Notice how we can kind of back into the math there. We also need to know how many total days it was rented. This is all information that is going to go on your tax return. So the faster you can get your accountant this information, the faster your tax return will get done, and the less they'll have to bug you for this information later. Then we need to know if this is a short-term rental or Airbnb, and you're trying to do the short-term rental loophole strategy, for lack of a better term, we need to know this information. What was your average rental period, right? Those of you may know it should be 7 days or less. That's for another video. And last, we need to know days used for personal use. Some of these expenses may need to be prorated if you're not using this property 100% of the time as a rental property. Next, we get to the good juicy stuff. We are down to the actual income and expenses on a rental property. First, you're going to see rents received. We need to know what rental income you have received so that we can report that on your tax return. And now we need to see all of your expenses. You can see here that we have a list of all of these expenses here. Advertising, auto, cleaning, insurance, management fees, mortgage interest. That'll be one of your largest expenses there. And you can even have spots down here to name these others as you wish. For example, one that is not on the tax return as a category of its own are HOA fees. Very common for rental property owners to have HOA fees. And coming down here, you'll see that we have net income. Net income is obviously going to be the net total, whether income or loss, for this property. You'll see that this property lost $2,650 on paper. I can tell you that that's a good thing. Again, another video for another day, but tax strategy wise, we want to lose money on paper on our rental properties. They're still going to cash flow, but we want to lose money on paper to help for our taxes. The last two things that I want to talk about right down here are refinance costs. So if you end up refinancing into a cheaper or more expensive mortgage, maybe less term, maybe 15 years instead of 30, we need to know that. And two, you'll see here capital expenditures. Very important that we track those. And what I want to make a highlight of is look right here where we have repairs and maintenance, and then you have invoices are less than $2,500 per, then a little note there. And then you have capital expenditures down here. If you have done a large rehab to the property, we need to make sure that we call that out separately as a capital expenditure so we can report it on the depreciation schedule of your tax return. And the important factor that I need you to remember here is if you spend more than $2,500 on something for this rental property, we need three pieces of data. You'll see here that we need the name of what it was. In this example, it's carpet. We also need the date in which you put it in service, because that's how we know when to start depreciating it. And I need to know the amount of what it was so that I can help you get the max amount of depreciation possible for that piece of whatever it is that you bought. And so rule of thumb here is if the item is less than $2,500, plug that to repairs and maintenance in that category and just put it there. But if it's more than $2,500, make sure that you're listing it out separately down here below so that we can make sure to depreciate it for you and report it properly. You'll notice here that this is just showing things in a categorical manner. This is giving your accountant the numbers at the end of the year. This is not something that you would do your bookkeeping with. I also have a template for that. I will link that down in the description if you need that. Feel free to grab it and use it. Your accountant will love you. We will love you if we work with you. Whatever the case is, it's something that you'll need to do at the end of the year. So what I want to end on this note with is this is the presentation in which any accountant that does your taxes would be glad to have. And not only glad to have, it's going to make your work go faster. It's going to keep your professional fees down because you're organized, and you're going to save in taxes because you're keeping track of every single penny to make sure that you don't miss on any deductions there. Now, I want to touch on quick on keeping track of expenses, and this is where every person goes wrong. Not only do they go wrong on not getting the bank accounts, which trickles down to them not keeping expenses because they don't have things organized. Missing out on expenses is by far the #1 most slept on tax strategy. If you're in the 25% tax bracket between federal and state, let's say, and you miss out on $100 of deductions, that's another $25 that you're going to pay to the government when you otherwise wouldn't need to. So I can't emphasize enough how important it is to keep track of your expenses for everything that you do when it comes to buying a rental property. Buying it and keeping track of all of that settlement statement, the purchase price, the closing costs, the escrow fees, the property taxes, all of it, as well as your day-to-day operational costs, HOA fees, insurance, commissions, things like that. Now, one of your largest expenses for a rental property is going to be what? Mortgage interest. If you get out a mortgage on your property, it's likely going to be your largest expense because it's the cost to borrow the money to buy the property. Every mortgage payment you make is broken up into likely two things, sometimes three. Principal, interest, and sometimes property taxes and insurance. So really four things. Pity, people like to say, P-I-T-I. Now, let's just specifically talk about the principal and the interest. In the beginning of the video, I mentioned that your principal and interest payment on this property is going to be $805 per month. But if you break that out, it's about $625 to the interest and $180 to the principal. Your principal is not a deduction on your tax return. Because if you think about it, the principal is you repaying back basically the purchase price of that property, right? That's the principal balance that you're lowering down. It's the interest that is deductible because that's the cost to borrow the money. So you're going to be able to deduct some of that cost of the building as depreciation. That is a separate video. If you are a real estate investor watching this video, depreciation is going to be your best friend in how you maximize your tax position the most by far. But when it comes to mortgage interest, we have to make sure that we account for all of our mortgage interest so that we make sure to take what? The deduction in the expense for it. At $625 on average per month, your mortgage interest on this property alone would be about $7,400 for the entire year just on that property. And you can imagine, let's say that you get $1,000 a month for rent in this property. Right there, that's $7,400 as an expense against the $12,000 that you've taken as income. So you can see the importance behind tracking this information to make sure that it ends up on your tax return to therefore lower the amount of tax that you pay. All of these are things that you need to consider when buying a rental property, plus a zillion things more. You will run into them being an operator and running your first rental property, but without having these major milestones in order, you're going to end up costing yourself a lot of time and money in the long run between fees and taxes. And so to give a quick recap, we have, should you get an LLC? Yes or no, that's up to you. That's really a personal risk preference. If you go yes, LLC, just remember you got to renew it. You got a little bit more admin costs, but also you are separating the liability between yourself and this rental property. Next is going to be bank accounts. If you get an LLC, you got to get an EIN number so that you can take your LLC paperwork and the EIN paperwork and go get a bank account at the bank. If you don't get an LLC for the property, that's fine. Get a separate personal bank account so you can keep track of all of your income and expenses. Next is accounting. We have a template linked in the description. Make sure that you're keeping track of all of your expenses, every single penny, so that come tax time, your tax accountant's ready to use it, save you money on your taxes, and hopefully charge you less because you're organized. And with tracking your expenses, make sure that you track every single expense that you're entitled to. So not only the money that you spent on the property, but your interest, your commissions, your cleaning fees, your supplies, your HOA fees, your utilities, every single cent. Make sure that you're tracking it. If you follow these steps when it comes to buying your first or 10th rental property, you'll be in a good position, I promise you. And as always, if there's anything else that you want me to cover as a CPA that specializes in taxes, we can go as easy as you want or as complex. Just feel free to drop it in the comments. I appreciate you watching, and I'll see you on the next one.